You're listening to the Decisive podcast, insights and analysis to empower confident decision making. Welcome to another episode of the Decisive podcast. I'm your host, Kristen Hallam, lead content strategist for Global Intelligence and Analytics. Today, we're diving into the European Union's Corporate Sustainability Due Diligence Directive and its implications for businesses across Europe. Joining me to discuss the regulation are Dijedon and Imeri and Louise Alestam, both with S&P Global Market Intelligence. Dijedon is a principal analyst for Europe CIS country risk based in Stockholm, and Louise is a senior analyst based in London. Dijedon, welcome back to the podcast, and Louise, we're excited to have you on for the first time. Now, before we start, I want to issue a little challenge related to this acronym for the regulation. The Corporate Sustainability Due Diligence Directive is also known as the CSDDD, CS3D, CS-DDD. I don't care for acronyms myself, so the challenge is for all of us to not use it when talking about it. We can call it the directive, the regulation, anything but a collection of letters. Are you up for the challenge?
It's not so much a challenge as much as a welcome intervention because
Oh,
it is
okay.
a very
We've had enough of it too, Kristen.
yeah.
Good. All right. We'll all try to keep each other honest then. Okay. So with that in mind, let's start as we usually do with a high-level overview. Louise, what is the regulation and what does it entail?
Yes, so essentially the regulation aims to enhance environmental and labor rights within international supply chains. So it does this by requiring large firms to implement new supply chain compliance procedures from January 2027 onwards. So more specifically, these are EU and non-EU companies operating within the European single market with more than 1,000 employees and with a global revenue of over 450 million euros. So this really means that companies that already meet these new standards and which are in a position to adjust to them relatively quickly, they're likely to have a competitive advantage going forward, while unprepared companies will face significantly higher compliance costs and bureaucratic burdens as a result of this regulation.
All right. And Dijedon, can you provide some political and historical context for the regulation?
Yes. So the way I would situate the directive or how I would describe it is as the capstone or the latest, the most ambitious of a series of regulations that seek to establish or consolidate the European Union's position as a global leader when it comes to sustainability. This level of ambition is also the source of some of the pushback against it. But just before I go into that, I think it's important to also not lose sight of the positive intentions behind this regulation and the likely net positive impact of it. Some of the dilutions notwithstanding, it does seek to address issues that relate to the respect for human rights and labor rights and environmental protection. But also on the other side of the equation, it seeks to address longstanding issues that have afflicted businesses as well. And one thing that comes to mind, and which we've frequently had to work with when dealing with clients who have sought to navigate non-EU markets, is reputational risk and some of the downstream effects of that, the consumer boycotts, etc. So the directive seeks to address all of these things, and this is why it's so ambitious. And to just give a sort of brief timeline and overview of how it went about, it was originally proposed by the European Commission in February of 2022. And while there was initially some agreement on the design of the policy, in December of 2023, there was pushback, rumored pushback from some member states who were afraid that the directive, as it was designed back then, would have a detrimental impact on their economies. So there was a pushback there. The original date for the vote at the council was pushed back. And only after a lot of horse trading and negotiations that entailed also increasing the threshold for the companies that would be affected by the directive was the legislation eventually ratified, initially by the European Parliament in April and then by the Council in May. And this is one of the points that me and Louise try to make in a report that we published in September, namely that the likelihood of further revisions notwithstanding, and Louise can talk more about that later, it's our contention that it is a very risky strategy for companies to assume that this issue will be revisited and renegotiated, because in many ways the political battle has already been fought, the compromises have already been made. And so assuming that there will be an extension of the deadlines, there will be some ameliorations here and there, is a risky strategy in our opinion. And so the best strategy going forward is probably to undertake the necessary steps to become compliant.
With that in mind, what kinds of penalties could companies face for non-compliance, Dijedon?
Yes, in addition to naming and shaming, the main form of disciplinary action would come in the form of fines. And the size of the fine would be dependent on several factors, including sort of type of infraction that has been committed. And I do believe the maximum amount can be 5% of the affected company's net worldwide turnover from the previous financial year. That's a pretty substantial penalty, one which larger and more well-resourced companies might be able to withstand, but which sort of mid-sized and smaller companies might have more difficulties with. So that raises the question of their financial viability in this new regulatory landscape.
Yeah, that is a significant penalty for sure. And as with any regulation of this kind, with this significance, there must be some concerns, if not a lot of concerns, that businesses have around implementation. Louise, can you
Mm.
share with us some of the primary concerns that businesses have?
Some businesses fear that the directive will lead to significant bureaucratic burdens and increased compliance costs for firms operating in the EU, as well as all those firms within their supply chains, because this directive mandates that large companies have to report and address environmental and human rights abuses throughout their entire supply chain. So that's full upstream and downstream supply chain visibility. A large majority of the businesses operating in the EU will likely have to conduct some due diligence checks on their many suppliers and contractors. And this is obviously what presents some difficulties. So first, obviously, because of the short time frame of the implementation, with these larger companies required to comply with the directive already from January 2027, that really is not a lot of time. Also difficult because of the sizable number of suppliers that are typically used by large multinationals, so the sheer scope complicates things. The directive will, thirdly, mean very comprehensive due diligence audits on many smaller and medium-sized suppliers, and these tend to have very limited internal reporting and governance capacity themselves. Then, obviously, we have complications related to highly globalized supply chains today. So, a large part of these supply chains are located in developing regions, which makes it very difficult for businesses operating in the EU to really have the necessary oversight for this full supply chain visibility. And lastly, there are concerns that the directive standards may disproportionately place the responsibility on global south suppliers, as compliance checks will be passed down really from the large firms to the smaller entities in the supply chain, who will likely struggle with the additional compliance costs, bureaucratic burden. A useful sort of example to refer to would be the German experience with their Supply Chain Act, which highlights many of these challenges, with compliance costs being reportedly much higher than they initially anticipated. So it does perhaps give us a good sense of potentially what is to come.
Yeah, tell us more about that German regulation. What does it do exactly, and what has been the impact so far?
So the German Supply Chain Act took effect in January 2023. And that was also introduced to improve human and labor rights across international supply chains. But as I mentioned, German companies have subsequently reported a very high bureaucratic burden and elevated compliance costs. So the average cost of implementation still remains disputed, so we don't know exactly, but it was still enough for industry pressure to prompt the German government to extend the deadline for the first compliance reports that were originally intended to be in June 2024 to January 2025 instead. And now it's looking like Germany will consider freezing the law, at least. This is what we're currently hearing from Germany's economy minister. Really, all in all, given the German directives, due diligence requirements are less comprehensive than those of the EU directive, and that Germany is typically more effective and better resourced to implement regulations than most EU member states. It does suggest that, yeah, EU member states will likely face even greater difficulties with implementing this than was the case in Germany.
And Louise, how might the EU respond to this corporate pushback?
So there's a strong likelihood, we think, that the EU will try to delay or dilute the directive to ease pressure on businesses. We think they would do this by either temporarily freezing or delaying the implementation of the directive, or alternatively expanding it into a sort of a multi-stage implementation process. So the German precedents that I talked about before, it suggests that EU member states with sizable multinational operations that they're going to push the council to extend the implementation deadline, probably by at least 2 years, I would say, and also permit longer term delays in the event of an economic downturn in particular. We also argue in our report that it's likely that some of the directives, requirements, and supervisory standards will be reduced. For example, policy makers might initially limit supply chain audits to direct suppliers, in the case of the German Supply Chain Act, before then subsequently phasing in the requirement for full supply chain visibility. Another tactic that we might see to soften the directive's impact would be to reduce the resources given to the supervisory bodies charged with monitoring the implementation. In effect, the sort of EU looking the other way while companies get their act together in the short term. So overall, yeah, in the end, it's likely that the sort of the practical implementation of the directive will probably be slower, lighter, phased in over a longer period and more adjusted to business interest than the original directive intended.
Interesting options there, a few moving parts to keep an eye on. So, how will the EU regulation affect the competitive landscape in Europe, Dijedon?
Obviously, this will depend on whether we see some revisions or dilutions being made, some of which Louise spoke about, or whether the European Union decides to go full steam ahead under the envisaged timeframe. If that were to happen, let's say, for example, if we have no leniency when it comes to ensuring that there is full down and upstream visibility, and the compliance costs simply become too much for some companies, that could potentially lead to a scenario where we see corporations basically reducing the number of suppliers that they engage with. Because you could imagine that, as challenging as this is, it becomes all the more challenging the more suppliers and variables you have to contend with. And so one way of addressing that would be potentially reducing the number of suppliers and thereby consolidating the market. In such a scenario, this would obviously confer a massive advantage to those companies that are in a good position to comply with the directive, to those suppliers that already have mechanisms in place to become compliant. They would have a very strong head start.
And are there specific sectors that could be more impacted than others?
So basically, any sector that is very reliant on global or globalized supply chains will be affected. They can expect more scrutiny. They can expect a lot of challenges around implementation. Obviously, some more than others, like electronics, for example, but essentially the entire gamut of sectors that somehow depend on international supply chains will be affected. In fact, in the report that I mentioned that we published in September, we try to visualize this in one chart with the example of a simple assembled good, namely an upholstered sofa, visualizing the number of suppliers that were involved and the number of jurisdictions that were also involved in the finished product, basically. And there's quite a large number of these involved. And that's just for a sofa. And you can imagine if you extrapolate this to other sectors with more complex goods that have more complex supply chains, this has a potential to be exponentially harder. It will affect all of those that rely heavily on international supply chains.
So, what indicators should businesses and investors be monitoring to assess the evolving risk environment associated with this regulation?
There are many things you could look at, and I can mention two. One would be at looking at what happens at EU level. Will there be a level of dilution or revisions to some stipulations of the directive, or will there be full steam ahead? And if there is a full steam ahead, then it becomes also very important to look at for other businesses that are not directly affected by this directive, because there is a way in which they could be impacted as well. Say, for example, in a scenario where compliance costs are transferred over onto consumers and this feeds into higher inflation, that might result in a macroeconomic situation where the European Central Bank is perhaps forced to decelerate rate cuts or even reverse that process. And that would obviously have implications for the entire economy. Then you can also look at what happens at the state level, because essentially the directive in question needs to be transposed to national law. And while some of the provisions require full harmonization, so you won't see any variation from one member state to another, there are other provisions that do provide a degree of flexibility. And I think this is important to monitor for companies because it means that the regulatory landscape in one member state will not be fully identical to another one. So keeping track of this will be very important.
I'm sure we could keep talking about this for quite some time, but it is time for us to wrap up our discussion on the directive. Any final thoughts for our listeners? Dijedon, let's start with you.
Yeah, one takeaway I think in terms of like how successful this directive will be is to not just look at the implementation as such, but to take a more holistic view and look at the sort of ecosystem of supporting policies. They will be very important in making this directive effective. To take just one concrete example, because there is an extraterritorial dimension to this directive, we have to consider the fact that some third countries will, or probably most of them, will be in a worse position in terms of resources and regulatory capacity to ensure compliance and to enforce these regulations. And so it will be imperative to also provide mechanisms and assistance to state institutions in third countries, be it in the form of financial aid, the provision of expertise, to help them basically implement these things, because they will be in a tougher position to enforce these rules than your average EU member state.
And Louise, how about you? Final thoughts?
I would really be keeping an eye out going forward on pushback or even sort of retaliation from these third party countries that see these regulations as an unfair imposition from the EU, especially in the context of existing trade conflict between China and the EU and potentially a sort of EU US trade conflict potentially. But I guess we'll get a better sense of that in a couple of weeks. But I think that's worth to keep in mind, keeping the sort of the non-EU perspective as well on this.
Thank you so much, Dijedon and Louise, for taking the time to share your insights with us. That wraps up this episode of the Decisive podcast, and I'm proud to report that none of us used the acronyms. Gold stars all around. We hope you, our listeners, found this discussion valuable in navigating the potential impacts of the regulation. Until next time.
Thank you.
Thank you.
Thank you for listening to the Decisive podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, Stay curious and stay informed.